Fair warning before you sit here and watch this, this is not a dopamine channel. What do I mean by that? No quick cuts, no confetti graphics, no wait for it. This is built to make your brain work, and it's built to challenge some of the beliefs that you've probably been swallowing without really chewing on them. So before you settle in, three quick questions you have got to ask yourself. One, are you afraid of actually thinking a topic through? Two, are you too lazy to sit through a video and watch the actual details? And then three, are you so locked into your beliefs and your biases that new ideas just bounce right off of you? If that's the case and you answered yes to any of those questions, scroll on. No hard feelings. However, if you want to take a real deep dive into fundamentals, if you're sick of doom scrolling the same recycled BS out there with no hard data or facts behind it, and if you want to stretch a few brain fibers that you may not have used since, I don't know, college or high school, stick around. I think you're going to like what you find. With that, let's get into it.
Welcome in, everybody. Today we are talking about the monthly market read for the National and Triangle housing market for June of 2026, presented by Deep Dirt. If you guys want any of these materials, they're all available at deepdirt.co for you to download. There's also a community there for you guys to take a peek at. So let's just get into it. Interesting month. This is the report we're pulling from. You can see it is a 25 plus page report, lots of information packed full of good materials for you guys. We're going to look at highlights. We're going to look at the triangle market specifically because we can drill down on some data that I think is applicable to the national story. And there's some interesting stuff happening there that once we go to the macro numbers, you'll see some movement that correlates and then some things that just don't make a lot of sense. Spend a good amount of time on today with the recession indicators. Want to make sure that we're digging into those numbers. I'm getting a lot of questions about a potential bubble in the market or a glut of inventory coming. Foreclosures are a big thing we'll talk about in today's episode as well. It is an interesting number that I'm seeing. There's a lot of, if this is true, then typically that thing is not true. However, in this market, it appears that it is all true. So we're going to get into all of those things. Again, this is all available for download. I'll remind you guys at the end. Local market, June 2026. If you're looking at month over month and year over year, green is good, red is bad. Not terrible though. We're seeing a lot of things move in the market. New listings continue to trend in a aggressive manner. So we're seeing more listings come on the market. However, that's not odd for this time of year. Going into the spring and summer months, we usually see our peak happen in these 2 months. Under contract sales dipped from May, but they are up 4.4% year over year. Closed sales, those improved in both categories. So we saw a little bit of a bump there. I have some theories on why. We'll get into that more in the macro section, but it is good to see the closed sales somewhat tick up. Median sale price continues to hold. The month over month improved much more drastically than the year over year. That 0.7% is not the appreciation rate you want to see, but we'll take it over a negative appreciation rate. Inventory for sale grew 2.6% month over month and 10.3% year over year. Double-digit gain on inventory. Again, something we're keeping an eye on. I have some thoughts about this. We're going to get into some of the conversations around inventory. It's also important to split the market a little bit on this and make sure we're really looking at resale versus new construction because they are operating in different extremes at the moment. Months of inventory, it's trailing that. It is going up month over month. And again, median sale price held. So you would expect the offer to list price to hold, and it did. I mean, it was within a basis point. And for that particular number, I don't like looking at the last listing price. I like the original listing price because that is a better indicator to me of if they mispriced it in the beginning, how much of a correction did they have to make versus if you dropped your price by 10,000 or say by 3%, well, that tells me either the agent wasn't doing their job when they priced the home or the market severely corrected that particular seller. So I like the original list price versus the final one. The final one doesn't give us enough of an idea around was it the market or was it the owner. Absorption rate declined month over month and year over year. We're seeing, as you can see in this chart on this side, we're starting to see this downward trend, which is not abnormal. Again, we kind of peak in those spring months, then we go we go down. And it levels off. We get a little pop usually after school gets back in session, and then it goes down for the winter. And we get all this new listing activity and sales activity heading into the new spring, and then we're right back down. So we're not far off our trend. It's just a little bit more aggressive than we've seen it. But we'll talk more about our absorption rate here in a minute. That's one of those things where people can get really caught up in a tanking market, and it's not as bad as it looks. Months of inventory continues to trend upward. I would remind everybody, and again, we're going to talk about this in a minute, 3.8 months of inventory. It is not a ton of inventory. It feels like it when you haven't had anything. It's like going to your pantry when it's been empty because you went away on vacation for a week and there's nothing there. And then suddenly you put in 10, 20, 30% of what you typically do, it's going to feel a lot more full because there's nothing there before. That's what's going on with our market right now. This is an interesting read. I don't see too many people talking about this. I like to take the appreciation rate and I like to map it out over really over a 20-year trend. And I use 4% as our baseline in the triangle market. We've had some more aggressive years here. It's been a healthy market. But if you just go off the normal 4% compounded annually, you can see that resale tends to hold its appreciation year over year. However, new construction is lagging. And it is lagging to the tune of 50,000. That is a significant gap in the market. I have theories on why it's happening, but it's good to keep an eye on when you split those two numbers apart. Activity trend trailing 18 months. New listings are sitting on top of the market. We can see this boop going up here, and then it kind of follows seasonal patterns and it goes way back up. Under contract and closed sales are mirroring each other. Your under contract is typically 45 days to 60 days ahead of your closed sales number, just because that's the amount of time it takes a property to work its way through the market. So no big surprises here. You are seeing the under contracts hover between this 3,000 and 4,000 unit mark. It has been able to break this barrier. Then when we go down here, it kind of pops a little bit this year, which is good to see. And then it continues to hold, and then you had the closed sales begin to crest over this, and that's from this happening. You're seeing it show up down here. So market is still moving. It's one of those things where we're not concerned at this point. It's just something we're monitoring in terms of the activity. This is an interesting couple of graphs in my mind, because typically when you see supply go up, demand would decrease, or demand's being met. However, median sales price is going up. We're recovering. Now, I always go back that if you really look at this graph, and it's in our charts that we put out for the monthly market report that you can download at deepdirt.com. All the data is there for you with all the charts. And this is mapped out back to 2004. And you can see an upward trajectory on this line. However, the past 3 to 4 years, we are somewhat in this plateau, this range right here. We are caught. We have not been able to get out of the 410 range. That being said, our inventory has steadily marched up. So at one point we were down to, I think, like a month of inventory. And now we have slowly crested upwards, going up as the months have gone on. So for the sales price to hold, to me, it goes back to the new construction versus resale conversation, where resale is holding the line mostly because that inventory has not been unlocked. So it's really two different stories happening out in parallel. And this is where you can see the difference in sale prices. And when you pull the stats on original list price received, you can see that these are pretty neck and neck. But the list price for the builder, you have to remember, has all these incentives priced into it. It's a massive amount of incentives between these two numbers. And what's always interesting to me is seeing how they run in parallel. They were pretty closely matched. And then we've kind of had this breakaway this year. And when we get further into the episode today on this, you'll see this is correlated pretty heavily with interest rates. The builders are fighting back with all the tools in their tool belt right now. And if you listen to their earnings calls, they anticipate this to continue, not go away. This is again just restating the difference between resale and new construction and really highlighting that appreciation gap. It's not talked about enough in my mind, and this is another example. It's been widening for a while, and there was a period here back in 2023 where new construction was holding out. But again, that's when the interest rate environment kind of changed. And then you started seeing negative appreciation in those projects. And then you're seeing this big decline. My other theory on all of this, if you want to know what's going on in the back of my mind, is there is the old land prices coming through the system. So in the land world, and for anyone who is new here, that's typically what we concentrate on as the land world. I like looking at the real estate data because it helps inform the land world. And this is one of those cases. Land takes anywhere from 2 to 4 or 5 years to work its way through a builder's system, its ecosystem. So when you place something under contract at the peak of the market back here, say it was 2022, imagine this goes over to 2022. When you place something under contract on the land side of things and you're working through entitlements and you're working through construction, you're working for the lots to get ready, finally you get your community out here, then it's getting launched, then it's getting started. What's happening while all that's occurring is your gap over here is widening because once those lots become available to build on and the houses be sold, they are now carrying this albatross of a land position from 3 years prior. Resale does not have that type of restriction on it. Resale just has to fight the current headwinds of interest rate affordability. So this gap, again, I think we're going to see a widening of this gap for the next few months. And then there's a possibility that the builders have worked out most of that land issues out of their system. However, I'll tell you that I have been on enough calls and had enough meetings now that they have kicked the can on quite a few of those projects. So I would not be shocked to see this continue a little bit more beyond what they're projecting on their earning calls right now. Just thinking that they've delayed some of the pain and they've pushed it off to some of their land banking entities or private capital partners or private equity partners or family offices, whoever they're using, they've punted it or they've slowed their takedown schedule. So it's not working its way through the system as fast. So I would not be shocked to see it come to fruition a little bit later. We'll see if that happens. We're going to keep an eye on this as it continues to go. I like looking at weird things and trying to see if there's correlations in our market. Now, I'm always cautious that correlation is not causation. Does not mean that because we see something in one spot that it is automatically causing something in another spot. However, there are some key things that I like to keep an eye on that are starting to raise their head up a little bit. New construction share of closed sales is at 28.3%. They have held that position for a while, and you can see it peaked pretty heavily over here in that 2023 timeframe. In my mind, from 2020 to 2023 was the run-up in the new construction market. We saw a lot of headwinds in that space. We had builders actually pulling lots forward that were supposed to hit the ground in 24 and 25, pulling them back to start them sooner to sell as many houses. This is when the wait list phenomenon was out there and you had, hundreds of people waiting for 40 lot subdivisions. It was a crazy time to be in new construction. That being said, that market share from almost 40% has tapered. You can see how it's tapered down as interest rate has hammered it. However, they are holding on pretty tightly here. And that's been, to me, the message is they have taken some ground in the market and they may have given back anywhere from 10 to 11% of it over the past 3 years, but they're surprisingly resilient. Now we are seeing it break this lower barrier of 30% for the first time. That is something that we're keeping an eye on to see if that continues to decline further. And if that happens, what does that mean for the market as a whole? Because we're not seeing enough resale inventory unlock to really allow new construction market to taper back. And I think that's part of the main problem we're having is that new construction has tried to step into the gap, but they have more expensive lots, which is causing them to have more expensive housing inventory on top of having an affordability issue across most of the country. So then they're using incentives, rate buy downs, all these different tools, which at the end of the day, each in their profit margins. So then they have to make a hard choice. Do we keep the machine running or do we bring our profit margin number down? Which one are we willing to do? And a lot of them have chosen somewhat of a middle ground, the Goldilocks approach, where they're saying, we need to keep the machine running. However, we're going to keep it running at an acceptable pace so that we're not sacrificing all of our margin and losing all of our profit and revenue just to get, just to allow the machine to continue rolling. And you saw that on the most recent builder calls. Several of them have backed their guidance off for the year. And what that means when they back their guidance off is they are seeing a cooling market. And I've always said that if you don't follow builder earning calls, you should, or you should join our community that we have so that you guys can keep up with it. I track these and look for signals out of all the noise that you have in the market. And they're so large. Most of these guys are so big that they see things in their markets 2 to 3 months, sometimes 6 months before we see them in our local markets. They just have incredible market knowledge because they have hundreds and hundreds of thousands of lots and housing product going in the ground on a monthly basis. So they know well in advance of us when the system is catching a cold and when it's about to get really sick. So they've already said that they expect the market to slow down. However, it'll be interesting to see if they allow this to dip below 25%. The other thing I'll note on this before we move on is the triangle market, by and large, is considered a flagship market for most of the builders in the country. When they come here to put a flag in the ground and make this one of their bellwethers because historically this has been an insulated market thanks to the tech that we have around here and the healthcare systems. We've had a very insulated market. Even in 2008, 9, and 10, I tell this a lot, I repeat it ad nauseum, even though the rest of the world imploded, we definitely felt a recession. We did not feel it like the other states that lost 50, 60, 70% of property values and saw foreclosures skyrocket at an unreasonable number. We are typically a little bit more insulated. So I say that to say I always keep an eye on the earning calls, and I like to keep an eye on this number to see if they're going to get back any ground here. And if they do, that should be a bigger sign for us that the market might be flashing, maybe not a red light, but a yellow light in what's coming our way. So the offer to list price spread, resale minus new construction, it's almost always negative, right? Just typically new construction run higher than resales, but their list price has incentives priced into it. So what I like to do is watch which way is the spread moving. And if you're noticing, it's tightening. It's got these kind of rhythms to it where in the March and April, May timeframes, that's because that's the spring market, they tighten a little bit. And then you see resale kind of bottom out during the winter markets and that tightens back up, then it bottoms. I've seen that pattern when you look at it across here. It's somewhat becoming less aggressive. And we're already seeing it in this area here. It'll be interesting how July, August, September shapes up. But we're seeing it go this way versus hovering around this area or doing what happened here and dropping down pretty far. Absorption rate year over year change. They are running negative year over year. That's the first thing, is that we're seeing multiple months of negative absorption rate when you look at it on a year over year basis. Typically indicates a cooling market. However, it is not a crashing market, and we are seeing that it is increasing. So the gap is narrowing from where it was here, where we were 25% difference year over year. It is slowly climbing its way out. The other interesting thing to note here, and I have an idea why, resale, the blue line here, is being beaten by new construction. How is that possible if new construction is selling for less and the appreciation gap is widening? They have more tools in their tool belt. They are willing to offer incentives. They are willing to do rate buy downs. They are willing to offer closing costs. They are willing to furnish houses. They're willing to do a lot of things that resale buyers or sellers just do not have to do. They do not have to promise the world to get a buyer right now. A lot of them are locked into these interest rates. They're like, yeah, we'll see if we can get what we want for it. But if we can't, then so what? We're going to sit on it. We'll put money into repairing the house. We have enough equity in the home that it makes more sense for us to repair it. Whereas new construction is saying we have to move the inventory. We have to clear our shelves off. I do like looking at this. It's a little bit of a play on how quickly a house sells. And I like to run these correlation data sets. So it looks at all the data sets over, I think it was like a 240 month period. And right now we're seeing most new listings versus close happen within that 0.6 range. So the lag is approximately 2 months from the time you see something go under contract to when it sells, or sorry, not under contract, when a new listing hits the market to when it sells, which correlates with days on market pretty closely for the market that we're in. This hasn't shifted over the past several months. So again, this is not a red flashing indicator in my mind. The other thing we like to do at Deep Dirt is forecast a little bit. And I like to do this in bands so that I have a high, a moderate, and a low. And as you can see, our new listings have just broken north of that band pretty much the whole year. Our high band was, I think, 15% above my moderate, and it still just broke out time and time again. Now, under contract and closed sales, those stayed pretty mildly where we expected them to be. I didn't think there would be huge movement there. I again, when it comes to forecasting, I always caution people, I'm not an economist, not that they are any more right in forecasting than a normal person. I just like to keep it very dialed into the fact that these are guesses and you can look at historical patterns. And that's how I come up with these numbers. I use seasonality numbers based over the past 25 plus years. And then I input that into essentially a forecasted model and say, well, what do I think the market's going to do this year? And I take into account what I know at the time, which when you do this in December of the year prior, you don't know what macro events are going to happen. You don't know if there's going to be a war that causes oil prices to spike or interest rates to climb or inflation gets out of control or if there's a pandemic. You don't know those things going into it, which is why I do a high, medium, and a low, and then I base it off of what we typically see in years prior from a seasonality spread. Most of the time, it's reliable to give you an idea, and it also allows you to somewhat see when the market's acting out of its historical character, which is what we're seeing with new listings. It has popped outside of its historical character. We have ideas why. We've covered some of those already, but mostly what I take away from this is that supply is surging, it's pushing, but the absorption rate is not capturing it yet. Will it catch up? I don't have super high hopes. We'll talk more about reasons why here in a little bit. I also don't have major pessimism about our market that I'm hearing across a lot of the news and the media and the social media channels. I think it's a little overblown. So we look at new construction. We can see that this is a little bit more grounded. Again, their listings, they've dumped quite a few, and that typically happens in that February to March timeframe. They throw a lot more inventory in the market to try and capture the spring market, and that is out of the model, the normal pace of the model for the past 8 years. So it is a little bit strange to see, but then you can see it ticks back down in April, May, and June to a more reasonable level. That's still on the high side, right? So that model is high, moderate, low. It's on the high side of the model. That being said, under contract sales fell right in line with where we thought they would. Saw a little bit of a pop in April, and that's because interest rates came down a good bit. But they're using all the tools in their tool belt to get those things to move. All right, let's get out of the local market and start going big. Let's look at what's actually going on in the world. Everybody knows what this one is: interest rates, the boogeyman of the real estate world. Every time we had a Fed meeting, it just seemed like people were very, very interested in hearing whether or not interest rates were going to go up, go down, lots of different stuff. When you look at the average on this, I have said this quite a bit, so hang in there with me. If you go back to 2004, and this is in the market report that you guys can download. If you go back to 2004 and 5 and 6, we were in the 6s and 7s prior to the Great Recession. We have become addicted to cheap money, and the market is somewhat helping correct that. Now, that's not the whole reason we're having affordability issues. There's a lot of other affordability issues, but this is one of the big reasons. You see some of the other stats on the screen: new home sales, 580,000, and the federal fund rate was held in June with no cut priced in. You probably heard the new Fed chair is hawkish, and it means that they don't anticipate there being a rate cut this year. However, again, that is all speculation. We have no idea what they will do. We do know that with inflation running a little bit hotter, there is less likelihood that they will cut the rate. I don't see the reason, if I'm sitting in that chair right now, that I would say, yes, we need to cut the rate. I know they want to stoke the housing market and get sales moving in this sector. However, the problem is with what's going on around the rest of the world right now, inflation becomes a real concern. And the only tools that the Fed has in its tool belt is to control that Fed rate. And it's not super high, 3.5 to 3.75. It's not a super high rate at the end of the day that if they have to do something drastic, that they can pull on this lever. I'm always looking for signals through all the noise in the market. And these are two signals, microcosms, that really give us a good idea of, is there something bubbling beneath the surface? I'm always curious about forecasting, and is there something bubbling beneath the surface that would give us an early indication, the canary in the coal mine, so to speak. First thing I always look at our local market is absorption rate, and these are seasonal peak percentages. So these are the highest numbers in that cycle. These are every 12 months. So you can see 2005, it was 19.4. 2006, it was 19.9. So we saw a gain year over year. And then 2007, you saw a 2.5% drop down to 17.4. And in 2008, the floor came out and it dropped almost 7 percentage points. So what does that mean? It means that we saw 2 years of negative growth and then the recession hit us full force, right? When we look at 24, 25, and 26, it's at 58.4 in 2024. And then we see a pretty steep drop in 2025. That's just the interest rate environment being held higher for longer. And then 39.4. So we have the same macro trend. We have 2 months of decreasing absorption rates. And absorption rates, just as a reminder, is how much product is being sold month over month, year over year, however you want to measure it. But it's how much product is being taken off of the market as fast as you put it on. The other thing we look at is the supply increasing? Is there more product on the market that people are just not buying, not willing to buy, or not able to buy? 2005, 2006, 2007, we saw a slight increase in the market, and then boop, it goes up 2.6 months in 2008. That's the lowest, right? So that's the floor of the year. So in your typical slowest month, they going up 2.6 months is drastic. Let's look at the difference in 24, 25, and 26. You're at 2.1, 2.7, 3. Okay, so in 2 years, you gained 5.9 months of inventory. However, I'll also point out in 2005 and 2006, we're at 5.6 and 5.7 months of inventory. That is 24 and 25. We're at half. Even in 26, we're still way under. Now, granted, we're at 3.8 this month, and it's climbing. Those numbers just are not shockingly high or fast, and we have not seen the glut come on the market. It all comes from having a healthier starting base. This market that we're in right now, we have some of the most cautious home builders that we've ever had. Whereas 2005 and 6 and 7, we had very much plethora of builders who were a little bit more risky, meaning they were willing to spec homes or put lots on the ground and do it in such quantities that if you really looked at the market, it didn't make sense. So when I look at these two signals, I don't see anything concerning at the moment. These are other macro signals that I keep an eye on. Yield curve. I'm sure everybody's heard of the yield curve. The 10-year minus the 2-year. Essentially, if you borrow money for a longer period of time, typically you get paid back more money for that money, speaking in fifth grade terms. When it inverts, it means that people are afraid something bad is going to happen in the long term, so they start buying short term because they know they can get that money back sooner. And then you start seeing that spike, and it inverts the yield curve. 2006 and 8, you saw it invert in November of 6. And then we had the recession, late 07 going to 08. 24 and 26, it did invert in 24, but it uninverted. And it is not signaling right now. The unemployment or SOM roll, it's a leading indicator of potential unhealthiness in the employment market. A little bit better than GDP, where GDP is 2 quarters of negative growth. SOM gives us a little bit more of a early indicator. So it's past 5% by 08. Right now, we're at 4.2%. We have not seen gains in this market up or down. So it's not signaling. 30-year rate, it was a slow grind, 5.7 to 6.8%. Took 2.5 years in 06 to 08. We had a shock with that. They put those brakes on hard and fast. So 3 to 7%. And then we've kind of been in that plateau since then. The housing index, this is builder confidence. Peak at 72, and then it went down to 18 in 2008. They were not in a good spot. 34 is where we're at right now. Builders are not confident. They don't love this market. They don't love doling out incentives. So that's not a shock that it's sitting there. The other thing I keep an eye on are the ARM share of originations. ARM is adjustable rate mortgages, meaning that whether it's a 2, 5, 7, 10 year, you have a interest rate that you get started with, a teaser rate, and then it changes. This happened in 06, 07, 08. A lot of those teaser rates came into effect, and there were balloon payments on the loans. That's where the subprime lending came in. And a lot of those buyers could not pay those notes because they had those ARM loans on their houses and second properties. 35% of the market in 2004 and 2007. Right now we're sitting at 10%. Big difference. Big difference. That's a very different lending system that signals health to me. So the amount of buyers potentially getting rate shock here, much lower. Here's some more macro signals. This is heady stuff, gets a little bit deeper in the weeds, but Case Shiller's been around for a hot minute. Great economist. It's one of the leading indicators in our market that we watch to see if the house price index is accelerating, decelerating. Right now, it is decelerating 13 straight months on the nominal. The real is decelerating for 11 straight months. That's once you factor out inflation. That's the biggest red flag in all the data that I've seen so far. Regional divergence, of course, different locales. This is becoming more pronounced. I think we're going to have to do deeper dives into local markets, which is why I like to bring up the Triangle market. It's a market I'm in, but the more I dig into it, the more I see massive splits between local and national. The national numbers one, they're lagging a lot of times, and two, they don't really tell us what's happening in hot spots around the country. Pending contract cancellation rate, they didn't really track it back in 06 and 08. They really started hitting this in 2017. That is high. Cancellation rates are high. And then home builder equities versus the S&P 500. The stocks of these builders tend to trade in line with the S&P 500 unless there's something going on in the system and then you start seeing it break. Right now, it's not signaling anything. They're sticking pretty much in line with the market. No distress signals at the moment. We are starting to hear that they're slowing some of their expected growth numbers down for the year, but no major issues just yet. And that's a builder by builder case too. I'll put that out there. Some builders are in a much healthier position than others, and their earning calls are demonstrating that for us right now. Now, foreclosures. I have seen so many people comment on foreclosures in this market. We're in major trouble. We have a lot of foreclosures coming. We have a glut of houses coming on the market. The forbearance period ended back in September of 2025. It's all happening fast. Well, I even saw a realtor the other day put something out there that telling their clients not to buy houses right now, which if that's how you feel, I'm on board with you expressing your opinion. Just back it up with data. I saw no data. And when I pinged them, I didn't hear anything back. So what we're going to do is we're going to get in the data. I'm a big don't trust the headlines guy. They really make it sound like it's the end of the world. You'll hear year over year percentage increase in foreclosures is like up 50%. It's been at record lows, guys. It's one of those things where you start, if you go from 0 to 1, that's 100% increase. It sounds huge, but it's 0 to 1. So the Adam annual foreclosure filing rate, here's your levels in the center here. This tells you normal, could be trouble, city's on fire. Call Superman, call Batman, call somebody because we in trouble. So below 0.5% is considered normal. We are at 0.31%, 2026 annualized. This is a green measure. MBA foreclosure inventory rate, percentage of all loans in foreclosure. If it's below 1%, we're good. 1 to 2.5. Problems above 3 to 4%. Remember the peak in 2010 was 4.6%. Sorry, that's problem. 0.53. I would say that that's not a big issue at the moment. 90-day delinquency, commercial banks below 2% was our average. 1.9% is considered green. 2 to 5 is amber. Above 7 to 8%. The peak being 11.4% in 2010. We are at 1.78%. And then completions versus starts. So this is an interesting one because one of the rumors that I've heard is banks are holding back foreclosures from happening because they're afraid it'll tank the market. We can track that. You can see the data essentially. And if you see completions are growing in line with or faster than starts, that's a good sign. That means that they don't have a backlog and they're getting through it. If you see it decelerating, that's a red light flashing. And if you see a big backlog of starts, meaning they have massive amount of people are filing and they have a massive line of potential foreclosures, that's a problem. Right now, their completion, they're actually speeding up. So there's no real evidence that banks are holding back foreclosures to protect the market at the moment. It does show servicers processing distressed loans faster than they have in over a decade, completions outpacing starts, and every absolute level still sitting at or below its pre-crisis historical norm. Now, they are rising, and it's real, and it's worth watching, and we check it every quarter, and we put it in our monthly reports to see if something major popped off, that month. Most of the time it hasn't. The year-over-year percentage sounds scary, but it's not the end of the world. You need to check the actual underlying data, check the guts of the system. Here's some slides to give you ideas on what that looks like. So the starts right now are at 18%, completions at 33%, so almost a 2 to 1. That is good. That means that the banks are not holding anything back. They are moving and processing at a very normal speed. In fact, average days to complete is shrinking, not growing. So 648 was the peak back in 2021, and then you got down to 577 and down to 563. So we're seeing declines. Granted, I will say that in this time period, you have to remember there was quite a bit of forbearance going on. So those days are stretched a little bit because of those numbers. However, we would expect to see it stay somewhat the same if there wasn't a move to release these foreclosures to the system. So I don't see any data saying that they are sitting on these potential foreclosure items going through the system. Foreclosure inventory rate, the peak 4.6% versus now we are at 0.53%. It is so much of a different ball game thanks to the new lending standards that are in place. So again, not something to be wholly concerned with. Filing rate, 2005. A little bit above 0.5%. Once you get above that 0.5%, we start raising our eyebrows a little bit. 2010, you see it went to 2.23. That's obviously peak of the recession. Not a good time. Nobody had fun during that time. And then 2020 and 21, again, I always qualify that with it's because of the recession and we had forbearance programs in place. So foreclosure data for that period, as much of the data is very skewed. I look at it with kind of a raised eyebrow. But 22 to 26, that's another 4-year gap there that you aren't seeing massive spikes. A 0.08% increase is not anything to get your feathers ruffled over. Could this change? It could change. They are processing more than they have processed. I would expect Q4 data to be more interesting for us to really get a beat on if there's some issues in the market. I will say that lending standards being the way they are, I think I don't think that's as big of an issue. So when I look at this market report, one of the biggest things I heard is that new listings are blowing past the seasonal ceiling. A supply glut is coming and prices are about to crack. I do buy that the supply signal is high. It has broken the high back to back this spring. Inventory's up. However, the crash, 3.8 months of supply, is still firmly seller territory. Remember, 5 to 7 months is considered a normalized market, and that's where you start getting more pricing power if you're a buyer. I do think this is more of a buyer's market. It's really strange to be this low inventory and it feel like a buyer's market. They have more options than they've had in a long time. There's fewer buyers that are able to afford it, or buyers that are willing to afford it. Because if you're in a home and you own a property and you locked in a low interest rate, you are making that cost decision. And until you see it get to, I think, below 5.5%, you're not really considering moving. Why would you? Unless you had a life event or needed more space. I'm just talking about from a pure want standpoint. It's just not enough to push somebody to want to pay more money for a property if they don't absolutely have to do it. So again, guys, this is available on our site, deepdirt.co. This is all the tools that are in there. We have a ton of stuff and people are always in there and posting things. And you can see this is the market report. This is the community we have. We have 3 different membership tiers. This tier is free. You should get in there and just get the free tools at the bare minimum. We put updates in there. We look at land parcels. We have paid rooms as well. You get upgraded tools, more access to different models that we have. You see some of those over here. We have a land calculator, a deal analyzer. We have risk models, utility cost estimators, GPLP models. All this is in there for you guys to download, steal it, rip it, do something with it. Here are the different levels. Dirt OS, that's our Dirt operating system level. That's the baseline level. Everybody should join. It's free. Just go join and steal the stuff and be in the community. And sometimes people drop deals in there and they put different information in it. It's doesn't hurt to be in there. Whenever we post market updates, we'll post them in that room. The deal room, the plat room are the upgraded levels. A little bit more deeper dives into things. We put the aggregator reports into our deal room. The land desk is in there where we break down earning calls with the builders and we do deep dives into pro formas and we look at different models. There's a lot more in that room than any of the other rooms. Office hours, more webinars, things for people to get on. We vet deals with people to look at what they have going on. If you have a live deal that you need somebody to look at and say, hey, what should the numbers on this be? We jump on a call, take a look at it. Plat room, kind of that middle room so that you can come in, you get upgraded tools, get field notes where you can post deals with other operators in the areas, get some off-market stuff going. Good time. Either way, you should join. There's free levels, lots of tools. Again, thank you all for watching. We'll see you next time when we get July numbers here in a little bit.